Welcome to part 3. In this video we will cover how to account for a cash flow hedge. This is a continuation of part 2 where we covered the fair value hedge, and in part 1 we covered the fact pattern. A recap of the facts covered in part 1 and part 2. So you have a company, Core Capital. This company acquired equipment via a finance lease agreement with a foreign supplier. Payments are made in euros, thus our amortization table that we have drafted is also in euros. We have been provided with the spot as well as average exchange rates for the relevant dates. The question requires us to provide journal entries, and the additional information in point number 3 draws our attention to the fact that we may apply hedge accounting as the qualifying criteria is met. Upon reading the question, a key focus area for this video is on the last paragraph. The company designated the FEC as the hedging instrument, and the hedge risk is changes in the cash flow of the payment of the interest portion of the installments and the changes in the fair value of the payment of the capital portion of the installments. From this we can clearly see that the capital portion is a fair value hedge that goes to profit and loss, and the interest portion is a cash flow hedge that goes to other comprehensive income, which is what we shall cover in this video. In terms of drafting our response, we need to understand how do we calculate the cash flow hedge. Your starting point obviously would be your timeline where you plot the relevant exchange rates, and obviously with reference to your amortization table that you previously computed. You need to understand, as at 31 August 2011, what is the remaining interest. And the way how you do this is you simply sum up the values that have been boxed in red. So 3397 plus 2770 plus 2117 plus 1439 plus 733 gives you 10,456 euros. This will then need to be translated into ZAR. And in order to do this, you will multiply it by the relevant exchange rates, being your FEC rate as of 31 August 2011 and your spot rate at 28 February 2012. You will then arrive at a FEC asset balance of 106,000 and 105,000 at the two different dates. Thus you have a negative movement of 732 rands, and this movement will be recorded in OCI. You can either do this the long way how you see it on the screen, or you can also do it the short linear way. Whichever method you choose is absolutely fine. And your next step is, now that you have this movement, obviously we need to journalize this, because in accounting, movements are the things that get journalized. In order to understand which direction you record this, whether it's a debit or a credit, firstly understand how your FEC asset is behaving. Your FEC asset is actually getting smaller, which means that you will credit FEC asset, and your contra entry would be to debit the cash flow hedge reserve. You will then jot a suitable narration. At this point in time, let us do a quick recap of the journal entries that we have posted with respect to FECs. In part 2 of the video, we accounted for the fair value hedge as shown in Journal 4. Journal 5, we accounted for this a moment ago. And if you look at Journal 4 and Journal 5, both entries hit the FEC liability account. Thus, as at 28 February 2012, when an installment is paid, on this date, you also need to settle your FEC. And the value that you have of 6677 in Journal 6 is equal to the sum of the two journal entries above. Are we done yet? Are these all the journals that we need to respond? And the answer is no. The next movement that we need to account for is the realization of our cash flow hedge reserve. If you remember, our interest balance as at 31 August 2011 was 10,456 euros. And our interest portion as at 28 February 2012 is 7,059. The difference between the two is 3,397. In terms of accounting for your cash flow hedge reserve and for the resultant movement within the reserve, you need to understand the mechanics of it. As your interest balance gets unwound, so too will your cash flow hedge reserve also need to get unwound. If you remember, in Journal 5, we calculated our cash flow hedge to be 732 rands, which was a debit. The next step would be for us to calculate what portion goes to profit and loss. Because as I've mentioned before, as your interest balance gets unwound, so too will your cash flow hedge reserve need to be unwound, and a portion of that 732 rands will need to be transferred or realized in profit and loss. In order to calculate this, you will need to take 732 rands, multiply it across by 3397, and divide it by the figure of 10456 opposite your unknown, and you will then arrive at 238 rands. And since 238 is a negative, this will mean that when journalizing it, you will need to credit your cash flow hedge reserve. In terms of your journal entry, we're going to credit our cash flow hedge reserve OCI of 238 rands. Can you think what the debit entry will be? If you said that the debit entry will be FEC liability, you are incorrect. The debit entry will have to be finance cost, and this will go to profit or loss. The balance of your cash flow hedge reserve as of 28 February 2012 will be $494. I hope that you have found this video useful. Click like and subscribe for more. If you have any topic suggestions in the field of accounting, feel free to comment on this video. Thank you.